Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. Despite the dramatic bank failures in the US and Europe this month, global markets have been surprisingly well behaved. Equities and bonds are higher than they were at the beginning of the year, Nasdaq and gold materially so. The dollar has been stable and equity volatility has subsided. Why is this? Well, probably in part because of the comparatively effective containment of the crisis by global regulators, particularly in Switzerland. But also because once again central banks have come to the rescue with super generous liquidity provisions. These typically limit contagion, but can also tend to inflate global assets, as we saw in the QE era. So what have we learnt from the events of the last 3 weeks, and where do risks now lie across your portfolio? First, we believe that the strong will get stronger across banking franchises. Yes, balance sheet risks are still real, but the bonds of the strongest global banks are potentially attractive. Second, beware hidden corporate debt that could destabilise global growth. Private debt markets, high yield and leveraged loans are all opaque, and I think will find today's interest rate backdrop remarkably challenging. Finally, watch for the risks in property, particularly commercial, and any associated leverage. A combination of higher funding costs, work from home, tighter regulation, and energy efficiency retrofits all provide huge funding challenges. We'll look at all of these risks in the slides ahead and attempt to provide a checklist for your portfolio. So let's begin by looking at the left-hand panel, the performance of markets for the year to date, and encouraging all of them for once are positive. Nasdaq up an extraordinary 14%, that's probably investors running to the super cap techs because they got cash on balance sheet. Gold rallied strongly during the banking crisis, off a bit but still up 8%. Global equities up 5%, UK gilts up 2%. Now those numbers for once won't look quite so good as for a sterling investor, because interestingly the pound has been the strongest G10 currency for the year to date. On the right hand panel, the dollar index about flat, no sign of a rush to a safe haven US dollars, that's encouraging. Against this relatively benign backdrop, where do the risks remain for your portfolio? Well, although we're coming near to the peak in rates, probably 25 to 50 basis points more of rate rises, policy is still tight. US rates have risen very sharply, as you can see in that blue line in the bottom of the left-hand panel, up to 5%. And as I reported last week, the Senior Loan Officer Survey, that's how tough bankers are being on their loan clients, is continuing to show tighter and tighter conditions in business loans and household loans. This is replicated across the world and does mean we should expect more accidents to come, even if general asset prices remain relatively benign. First, let's briefly consider the bank sector. Our own view is that some of the risks now has gone from there, particularly for the stronger banks with the stronger bonds. In the left-hand panel, I've shown the World Contingent Capital Index. That's AT1s or bailout bonds that caused all the problems for Credit Suisse. Look at that surge in yields and that big drawdown. That's beginning to mute and stabilise. And particularly for more senior bonds, we're relatively happy that despite a tough run for banks, I put the equity numbers on the right there, a high-quality bond from a high-quality bank is probably safe and a good source of income. What I'm now more worried about is wider distribution of leverage right across economies. The IMF again reported this week a rising corporate risk. They see that as the number of companies at risk from corporate distress. Now that blue line showed many at very low risk because, of course, in the COVID years we flooded the companies with money through furlough and subsidies. As those have been pulled away, that light pink bar is widening, medium risks beginning to accrue. It could come in the emerging world, it could come in a highly indebted economy like Italy, but we need to be on watch for generally high corporate debt levels. The third thing that worries me is property. On the right-hand side, I'm particularly concerned about commercial property. Prices falling sharply, that's a minus 15% over the last 12 months, reported by the giant Green Street advisors for the US. Probably those numbers are getting worse. And landlords are being hit by three things: rising rates, increasing climate costs as they retrofit for low carbon era, and of course work from home, which is mitigating demand for property overall. On the left-hand panel, the IMF just flashed a warning that also residential prices are starting to fall. 2/3 of economies for which the OECD track housing prices saw declines in the last quarter. Particularly sharp falls in Denmark, New Zealand and Sweden, all areas where house prices rose dramatically, and you can see the sort of problems they're now facing. My fourth and final risk is in the opaque areas of the financial market, the unlisted areas, in high yield bonds and institutional leveraged loans, and particularly in private debt, which those bars show. That green bar is the growth in private debt from almost nothing in 2008 to a major asset class today. Yes, the venture investors still have dry powder in yellow, but combine all those areas and leverage is worryingly high. And also on the right, credit quality is deteriorating. I plotted here net debt to EBITDA, how much income you have to pay the interest cost on your borrowing, and those numbers are beginning to flash red for a number of financial sectors. So what does this mean in summary? 1. Bank debt. Remain careful, but don't think you have to exclude all high quality bank debt from your portfolio. 2. Go through your portfolio line by line, looking for excessive corporate debt, particularly in weaker economies. 3. Steer a wide berth for the moment from commercial property and associated borrowing. 4. Begin to look carefully at your residential residential property positions if you have them. And 5. Don't get too tied in to private debt markets, high yield and leveraged loan, and then find that with this interest rate shock, which is still rippling through the world, you're left with illiquid investments and large write-downs. Well, I hope that checklist is useful to prepare your portfolios for the rest of 2023. Thank you.